Good morning, everybody, and welcome to InsureTalk59, nearly my favorite number. It's the first InsureTalk of 2026, and I'm delighted to be co-hosting this. My name is Carl Nalter, for those of you I haven't met before. I'm a co-founder of CN&CO, but I'm double-hatting today because I'm also the Chief Enablement Officer at Easy Equities, our headline sponsor for today. So today's theme is New Horizons in Financial Advice, Global Perspectives, Smarter Portfolios, and the Evolving Digital Economy. It's a long title. We couldn't have something like that late in the year. We need it at the beginning when our brains are working. It's a big theme, big shifts, big conversations. And as I mentioned, many of you know that Easy Equities is the headline sponsor, and we're very proud to be that. At its heart, Easy Equities is built on a simple idea, making investing accessible to everybody. Poor, rich, doesn't matter, everybody. And today, Easy is a community of over 2 million registered users, South Africans choosing to take ownership of their financial futures. Whether that's through shares, ETFs, crypto, property, it doesn't matter. But conversations like the ones we're going to have today matter, because investing and insurance aren't at opposite sides of the spectrum. Both of them help us to grow and protect our wealth. Both require advice, both require discipline, and both rely on trust. The financial services industry plays a critical role in helping people do well, securing their futures. I'm delighted, as always, to be joined by the smart, the sexy, the sassy, the superb Carly Estreisen. Carly is pregnant, which is even more exciting because her and Jack make perfect babies. She's with us for another few months before she's going on maternity leave. And so, as we know, pregnant women are even more productive, so we are squeezing in and giving her another gig. So over to you.
Well, thanks for the gig and the awesome intro. It's nice to be here. Guys, if there's one thing that's clear right now, it's that financial services is not standing still. Between AI, crypto maturing, global markets finding their feet, and advisors serving 3 completely different generations, the ground is moving. So we've brought together a lineup today that reflects exactly that: global thinking, practical insight, and a proper look at where advice is heading. Now let's get some housekeeping out the way. Please submit your questions via the Q&A section, not the chat. CPD points will be accredited 2 weeks after the session, and please make sure you're registered with the same email address you used for the conference. Now, a little exciting moment. One person joining us today with an Easy Equities account stands to win 1,000 Rand invested into the Cartesian Easy ETF's Balanced Actively Managed ETF. And if you're on Thrive Level 3 or higher, we boost that up to 5,000 bucks. So really exciting for someone that's an Easy Equities user today. And if you're not, getting an account is really quick and easy. No judgment for double scrolling or double screen timing this time. Why not join over 2 million investors growing and protecting their wealth on the easiest, most fun, low-cost place to do that? Also, don't forget to register for the full InsureTalk 2026 series at InsureTalk.co.za. Make this part of how you sharpen your thinking this year.
Thanks, Carly. And I think now is time to get going with our first speaker. And are you going to bedazzle us with a brilliant intro? Who is it? Drum roll?
Drum roll. Should I sing it? No, we'll just go straight in. We'll just go straight into it. Emil van der Linde, Head of Operations at Easy Crypto, is up next. Now, Emil is one of the calmest, coolest people I know in one of the most misunderstood industries, which makes him exactly who you want explaining crypto. He's unpacking why crypto isn't what you think it is anymore, and what's actually happening behind all of those headlines. Over to you, Emil.
So, good morning, everyone, and thank you to InsureTalk for having me, and thank you for that lovely intro, Carly and Carol. Before we get started, and I think, excuse me, Carly mentioned this already, but just a small housekeeping note. If you have any questions, just drop them in the Q&A box, and I will get to them, or to as many of them as I can. So let me just share the screen. Okay. Now, the title of my talk today is Crypto Isn't What You Think It Is Anymore. And I chose these words deliberately because most of us, and I include the financial services world broadly, formed our crypto opinion years ago. And that opinion was based on what we saw at that time, which was speculation, volatility, big headlines, scams, meme coins, etc. And that opinion wasn't necessarily wrong. It was just based on evidence from that time. But this evidence has changed, and I think our mental model hasn't kept up with where the industry has gone. So today, I'm not here to debate crypto. I'm not here to convince you to buy anything. I'm simply here to update your mental model with real data. So a quick bit about me. As Carly already said, I'm Emil van der Linde, Head of Operations at Easy Crypto. For those of you who don't know us, Easy Crypto is the crypto arm for Easy Equities. So we sit inside this regulated, established financial services ecosystem. My background is in mechatronic engineering, so I came over to crypto through systems and structure and not necessarily through all of this speculation. My day-to-day focus is essentially compliance, infrastructure, custody, operational risk, etc. So I sit where crypto meets regulation and adoption, not where it meets hype. And that is the lens that I will be using today. I do, however, realize that I am a crypto guy in a room full of insurance professionals, and crypto hasn't always inspired a lot of confidence, which is a fair point. So instead of taking my word for it, I wanted to have a look at one of the most established figures in traditional finance and what he had to say versus what he had to do. And this is a man who most of you will probably know. And he has been very publicly, repeatedly, and very loudly, he has criticized crypto over the past couple of years. So Jamie Dimon, the chairman and CEO of JP Morgan Chase. For context, JP Morgan has over $4.4 trillion in assets. They serve more than 90 million customers globally, and Dimon has been in the financial and banking space for over 40 years. So if there's anyone who represents mainstream banking skepticism towards crypto, then it's definitely this guy. So he has been, as mentioned, the loudest, most consistent critic of Bitcoin in the financial world, or at least he's been one of the loudest. So I wanted to start this presentation by taking a look at what Jamie has said versus what he has actually been doing over the past couple of years. So here we've got the Bitcoin chart over the past couple of years, and I've taken some key points where Jamie Dimon and or JP Morgan did certain things or said certain things. So we'll start with September 2017. Bitcoin was trading at about $4,000. Dimon goes on stage and calls it a fraud, and he says that he'd fire any JP Morgan employee caught trading it. Fast forward to Feb 2019, Bitcoin is trading at about $3,400. And what does JP Morgan do? They launch JPM Coin, which is essentially their own blockchain-based digital token for institutional settlement. Then we move to January 2024, where Bitcoin is trading at about $42,000, and Diamond calls Bitcoin a pet rock. He says it does nothing, and he says that that will be the last time that he ever talks about it. We then go forward to May 2025, where Bitcoin is trading at $94,000, and Diamond announces that JP Morgan clients can now start buying Bitcoin. Now, the important part about all of this is not that I'm trying to take a jab at Diamond, and it's not about being right about the price or the movement of Bitcoin in any way, but what I'm trying to highlight here is a pattern. And this pattern is public skepticism and big headlines versus what infrastructure is actually being built in the background and why you need to update that mental model of what we used to believe about crypto. So to further explain this, let's look beyond Diamond personally, and let's look at JP Morgan as an institution, as they tell the story even more clearly. So before 2020, they had never banked a single crypto company. And then in April 2020, they took on Coinbase and Gemini as their first crypto clients. And by late 2023, JP Morgan was named as an authorized participant for BlackRock's Bitcoin ETF, meaning they are sort of part of the mechanism that creates and redeems shares for this fund. So this is the same bank that wouldn't touch crypto is now helping institutional Bitcoin flow into brokerage accounts. And they're not alone. We had Goldman Sachs disclose over $2 billion in crypto ETF holdings, and Morgan Stanley started offering Bitcoin ETFs to their wealth management clients. So again, the important note here is that these are not crypto companies. These are some of the most conservative, risk-averse institutions in global finance. And they don't move because they get excited. They move because their clients demand it and regulations allow it. So this pattern isn't just unique to Jamie Dimon or JP Morgan or Goldman. It played out across the entire financial system. It is structural changes quietly in the background. And that's what I want to walk you through today. So for years, this is what crypto looked like. And the image you see there is essentially an AI-generated image of what people thought about crypto a couple of years ago. And that's essentially just, retail speculation, meme coins, unregulated exchanges, scams, etc. Basically just the wild west of the financial industry. And I wanted to go a little bit more specific because I think many people are probably thinking about the exact same names right now. And I wanted to make a point with some of these examples. So we had Mt. Gox in 2014, which was one of the biggest Bitcoin exchanges in the world at the time. They handled about 70% of all Bitcoin transactions. 850,000 Bitcoin gone, worth about $470 million at that time. We had BitConnect, which collapsed in 2018, which was a textbook Ponzi scheme dressed up as a lending platform. $2.4 billion taken from investors worldwide. Then we had OneCoin, which was a very popular one. It was marketed across Africa and Europe as the next Bitcoin. It was never even a real cryptocurrency. The so-called crypto queen disappeared with an estimated $4 billion. And she's been on the FBI's most wanted list since 2022 and has never been found. Mirror Trading International recently made an appearance on Carte Blanche again. And then, of course, we had FTX in 2022, where Sam Bankman-Fried running what turned out to be one of the largest financial frauds in modern history. At least $8 billion in customer funds was misappropriated. So these weren't edge cases. These were front page global headlines. And the reason why I'm bringing all of this up and highlighting all of this in today's conversation is because this is what shaped an entire generation of financial professionals, people inside of this room or listening to this presentation today. It shaped how we think about crypto. And that mental model was definitely earned, but I think it's important to look at what happened next. And this includes things like the FSCA making moves, the SEC making moves, the EU making moves. So there was a shift, and this shift wasn't emotional, it wasn't sudden, and it wasn't really driven by retail enthusiasm or social media hype or anything like that. It was and has been incremental, quiet, and structural changes to the crypto environment. And I wanted to share some of this evidence layer by layer to see if I can influence your mental model about crypto today. So let's start with stablecoins, because this is where the real infrastructure story actually lives at the moment, and it's also one of the most talked about concepts currently. A stablecoin is, in simple terms, a digital token pegged one-to-one to a traditional currency. Generally, or in most cases, it's pegged to the US dollar, so you can have one USDT that equals $1, and that's what this is built on. One token has to equal one unit of that fiat currency. So it doesn't fluctuate like Bitcoin, and it's not there to speculate on. It's designed essentially for settlement purposes on blockchain rails. I wanted to look at these numbers by Artemis. And these numbers can vary from source to source, but Artemis is a very trusted data source, so I decided to go with this today. And in the last 30 days alone, stablecoins have processed $7.8 trillion in transaction volume, over 1.8 billion transactions, and these all are coming from about 51 million unique wallet addresses. So $7.8 trillion in adjusted transaction volume in the last 30 days alone. To sort of just put that into a scale, that annualizes to over $90 trillion. Now, this transaction volume might be inflated a little bit with a bunch of different ways, and I have to admit that it's not the same as just consumer card payment. This does also include things like institutional settlement, treasury flows, and cross-border transfers and things like that. But that's exactly the point that I'm trying to make. This is financial plumbing. It's building the future of financial infrastructure. And it's moving at a scale that just didn't exist a couple of years ago, 2-3 years ago. So you'll see the total supply of stable coins are currently sitting at $306 billion. And if you look at the stablecoin supply by token, you will see that we've had very steady growth over the past couple of years. So this isn't some sort of bubble pattern. This is consistent growth of infrastructure that's scaling very efficiently. And I have to quickly mention this, as it just so happens, we are also building some of this infrastructure ourselves. Easy Equities, in partnership with Sanlam, Lusaka, and Luno, recently launched Zaru, which is a very exciting South African rand denominated stablecoin, but I will leave that conversation for a different discussion. So it's not just crypto native companies using this infrastructure. And this is a very important slide because traditional payment networks have also plugged in. We have Visa, who is now processing stablecoin settlement, or Visa is now processing stablecoin settlement at an annualized rate of $3.5 billion, and this is growing. We have MasterCard, who has expanded their crypto card programs globally, and they are piloting stablecoin settlement within all of their existing merchant networks. And then, of course, we have PayPal, who have launched their own stablecoin, currently sitting at about a $4 billion market cap. So it's important to think about what this means for a second. These are companies that operate under some of the strictest compliance frameworks in the world. Visa and MasterCard don't just experiment with technology lightly. They execute again once they see that there's scale, once there's demand, and once there's actually regulatory viability. So I mentioned this is a very important slide because this signals that there's a large integration into some of the biggest existing ecosystems, and that we're not trying to necessarily disrupt all of them. And I think that's an important note to take away from this presentation. And then, of course, Wall Street arrived. So this is a long one, but these are all big events. I wanted to go through each of them. In January 2024, the SEC approved spot Bitcoin ETFs. BlackRock's IBIT surpassed $50 billion in assets under management, and it became one of the most successful ETF launches in history. Then in March 2024, again, BlackRock launched BUIDL, which was a tokenized money market fund on the Ethereum blockchain, and this grew to nearly $3 billion. So again, this is a major asset manager issuing traditional financial products on blockchain rails, which again gets us to, or links us to, the fact that new financial infrastructure is being built and being used by some of the biggest asset managers out there. Then by late 2025, tokenized real world assets exceeded $35 billion. So this includes tokenizing US treasuries, private credit, institutional funds, etc. All of these things are moving on chain. And again, this was driven by BlackRock, JP Morgan, and Franklin Templeton. And then in July 2024, the SEC approved a spot Ethereum ETF, which is important to note that this regulated institutional access is moving beyond just Bitcoin. It's moving to altcoins as well, as a Solana ETF has also been approved. So the key message here is that this is a regulated capital. Crypto moved into brokerage accounts. It entered portfolio allocation models. It became something that advisors have to understand, whether they like it or not. So it's a massive shift for this kind of regulated capital. The next shift was that banks have integrated. So closer to home, we've got Absa, which of course is one of our major South African banks, and they partnered in October last year with Ripple to build digital asset custody infrastructure. So that's a South African bank operating under all of our regulations, building on or building blockchain-based custody. HSBC launched tokenized gold and digital bond platforms. So again, you get traditional assets being issued and transferred on blockchain rails. And then, of course, JP Morgan, the same bank whose CEO called Bitcoin a fraud, now operates Kinexus, which is their blockchain settlement platform. And they process over $2 to $3 billion daily in wholesale institutional settlement. And this platform has reportedly processed over $1.5 trillion since inception. Now, the interesting thing about this slide is if you were in crypto about 5 or 6 years ago, this slide would probably make no sense. Banks were the enemy. That was the original ethos of Bitcoin. It was to decentralize everything, bypass the banks, remove the middleman. And this basically resulted in banks returning that hostility. They wouldn't open accounts for crypto businesses. They'd freeze transactions flagged as crypto related. And I'm sure some of you may even know this or remember this, but in South Africa, many crypto platforms actually struggled just to maintain basic banking relationships. So there was a period where the banking sector and the crypto sector were completely hostile to each other. So what changed? I think two main things, which is a regulation. It gave banks a framework to engage with. Once the FSCA declared crypto a financial product, once licensing went live, banks had this compliance pathway. They could say yes of instead just defaulting to turning people away. The second was that client demand just made this unavailable. When BlackRock is tokenizing funds, when your institutional clients are asking about digital asset custody, when stablecoin settlement is processing trillions, then you can't just sit on the sidelines. The risk of not engaging basically became bigger than the risk of engaging. And that's the shift. Banks didn't necessarily become crypto believers, but they did become crypto realists. So again, and I've mentioned this takeaway a couple of times, but banks don't just build this infrastructure casually, and they don't just experiment with these kind of things. They build this when the risk is measurable, when client demand justifies this investment, and when regulation actually allows it. Which brings us to regulation. And I think this is the part that probably matters most to most people in this room. So just a quick overview of some important events over the past couple of years. The SEC has now approved spot ETFs for multiple coins from Bitcoin, Ethereum, Solana, etc. And crypto has sort of moved fully into this regulated securities markets. Here in South Africa, the FSCA declared crypto a financial product, and they've licensed hundreds of crypto asset services providers under formal regulatory oversight. And then globally, we've had over 85 jurisdictions implement the travel rule, which is basically bringing crypto transactions into standard anti-money laundering and compliance frameworks. The travel rule is an interesting one. I've personally worked with this a lot over the past couple of months to get this implemented on our side. And it's been a big topic of discussion because it sort of takes away the anonymity of crypto, which goes against what many hardcore crypto believers believe in. But I found that for crypto to succeed, then working with regulation in ways like this is very important, as it does at the end of the day reduce risk and protect consumers. So what has actually changed? I talked about a lot of shifts and showed a lot of slides, but I thought it might be good to summarize this in one slide, as it's quite a lot of information. So just shortly, the capital shifted from retail to institutional regulated markets. The product shifted from unregulated exchanges to regulated ETFs and funds. The rail shifted from trading infrastructure to settlement infrastructure. Think about stablecoins. The posture shifted from resistance to integration. Think about all the examples of banks integrating, which we just walked through. The stage shifted from pilots to production scale. And the framework shifted from fringe to regulated, which again is probably one of the most important changes we've seen in crypto over the past couple of years. Now, everything that I showed in this presentation up to this point is not a prediction or a forecast or my feelings about this industry. This is things that have already happened. So why does this matter to you specifically in this room? I thought about it for some time when I was building this deck or this presentation. I came up with 4 points I think make this important to everyone listening here today. And the first one is access. So individuals and institutions now have access to crypto exposure through regulated, which is the important word, ETFs and institutional platforms. So they may already hold it. They may be asking their advisors about it. So this is no longer a fringe question. Everyone has access. Then secondly, integration. Major banks and asset managers, again, think of all the examples we talked about, are directly participating in digital infrastructure, and they are moving a lot of infrastructure onto blockchain rails. So these could be institutions that you work with, that you insure, that you advise. They are already in this space. Then, of course, settlements, which again brings us to stablecoins. So stablecoins and blockchain rails are starting to influence or already influencing how money moves and how liquidity is managed. So this will be payment cycles, counterparty risk, treasury operations. All of these things are being reshaped by crypto and blockchain. And then, of course, risk, which is a big one for insurance, is we've got custody risk, counterparty risk, fraud risk. These are all evolving alongside crypto adoption, and its evolving quite rapidly. So the risk landscape is changing. New products, create new exposures, and these exposures need to be understood, and they need to be modeled, and they need to be managed. So I'm not saying that you need to buy crypto. What I am saying is that you need to recognize that it's now part of the financial system, and that changes how we think about risk, and that should change your mental model about crypto. And on that note, for those of you who want to go deeper into crypto, we are actually building a crypto CPD course at Easy Equities, designed specifically for financial services professionals like yourself. And given that you're already earning your CPD points, I think you might find that relevant. So keep an eye out for more information on that on our social media. So what I want you to take away today is that the headlines are always loud, but the integration has been quiet. It's been behind the scenes. It's been consistent, and institutions are moving on this. They are moving fast, and infrastructure is being built that's changing the way we look at the finance industry. And on top of that, we've got regulation is maturing at a very quick pace. So crypto isn't what you think it is anymore. It's already part of our financial system. And I think it's time to update our mental models. Thank you.
Wow, thank you so much for that, Emil. You're making me think about the first time I bought crypto all those years ago with my eyes closed and thinking, what am I doing? And now it's such a crucial part, for me at least, of my investing portfolio and on an institutional level too. So thank you so much for that really interesting chat. Up next, we have Anthea Gardner, founder and managing partner at Cartesian Capital Asset Management. Now, Anthea and I go way back. She's been building wealth with our community for nearly a decade, and I've loved watching her journey as a best-selling author, yes, she did that, and an easy equities partner. She's going to be talking to us today about what an ideal portfolio looks like right now. Hello, I'm taking notes. In a world that seems stable on the surface, but still demands discipline underneath. Over to you, Anthea.
Hi, Carly. Hi, I'm guessing everyone can already hear me. Take that as a yes. Carly, you look fabulous, and I'm always so excited to speak to you because you're such a keen investor. So let's get started. Thank you, everyone, for the responses. Sorry, I couldn't see myself for a minute there, and heaven forbid, right? Okay, so I'm sure you can all see my screen now, and I'll just start my presentation. I have been a partner with Easy Equities for over a decade. I can't believe it. It really is a partnership I treasure. So I'm so glad my team's not here, by the way, because now that I look at the slide, I love telling the story of how or why I chose the name Cartesian Capital, and my team have heard it 12,500 times by now. So the name Cartesian is derived from the French philosopher and mathematician René Descartes, who you'll know because he said, I think, therefore I am. But of course, because he was French, he said, I think, je pense, donc je suis, I am, right? And he was also a mathematician, and he created, if you remember your school mathematics, the Cartesian plane, which is where you plot the XY axis. And jumping ahead, and if you put the numbers that are circled in the right-hand side of your screen into your navigation system, so your Garmin or whatever you Waze or whatever you use, Google Maps, that'll bring you straight to the offices of our Joburg offices, I should say, because we recently opened Cape Town office. Right, let's get going. So when thinking about your ideal portfolio, there's so many options. You really need to consider the best way to implement it. And I think the first port of call is to start with the goal in mind. Or as one of my favorite athletes says, skate to where the puck is going, not where it's been. So that's Wayne Gretzky there. And so there's so many things to consider. And I think the first thing you need to think about is what is your risk tolerance? And for retail investors, I define risk as volatility and the risk of the market being down when you need to withdraw your money. And you know Murphy's Law, right? It's inevitable that, like during COVID, the world shuts down, markets collapse, people get fired, and are then forced to access their funds just to survive. And that is perfectly the wrong time to do it. So when COVID happened in March, I can't even remember the year anymore, but the share was down. The all share was down. The South African stock market was down 30% in like a heartbeat. And so then can you imagine having to withdraw your money when you looked at it in February, you thought you had I don't know, R1 million. And suddenly you look at it at the end of March when you need it and you've only got 700,000 or close enough. And then the second thing to think about is, what are you planning to use these funds for? Because, you know, you invest today for the future, right? And this also determines how long you can be invested and how much risk you can take. So, for example, you don't want an emergency fund to be in a risky or volatile fund. You want it to be in a safe money market fund where capital preservation is the main goal. The rule is also, so kind of this quandary, this investment quandary, the rule is also that you need to take risk to make money. And you'll see what I mean in a few minutes. And so in your longer term funds, you need to be invested in more volatile assets such as equities. And equities are not really risky, but we classify it in South Africa in a risky asset class. But hopefully they're more volatile, you're taking more risk. And so you should get compensated for taking this risk, and you should get higher returns than on your money market funds. And then the third thing I think is always be cognizant of what you're investing in. So as institutional fiscal registered fund managers, Cartesian has a fiduciary duty to be careful to not invest in, I don't know how to say this, dodgy investments. We also have to be careful to do our anti-money laundering processes. So no arms dealing, no funding of terrorism, all sorts of things. So all of that's off the cards. But, you know, there's also some people will not want to invest in tobacco manufacturers or alcohol sellers. So that's kind of a thing we really need. We do take care of or cognizance of when we're building your portfolio, and something for you to do as well. This is an old conversation, local versus offshore, especially for South Africans. You know, historically, we've had, I guess, a depreciating currency until recently, of course. And so what you want is a nice diversification of kind of rands versus, and a lot of people talk about hard currency, US dollars or euros or pounds or whatever the case may be. Of course, in the last couple of months, the rand is so strong that your offshore investments would have returned a lot less than your local South African investments. You know, there's a saying that says, live in the sun and invest in the shade. I'm not sure that works this year. They're assuming that emerging markets are sunshiny and that developed markets are shady. So, of course, we did a lot of research, but I want to point out this one aspect of our research that we did recently. We wrote a strategic asset allocation document. And so what we do is we look at the regions and the asset classes globally. We analyze kind of the economic situation and decide where we want to be invested, both regionally and in which asset classes. So this is just one of the points or one of the aspects of our research concluded that I want to point out to you. And the dark blue bars are emerging markets and the light blue bars are developed markets. And all I did was I took the 10-year government bond for each country, subtracted the CPI or inflation to get what we call the real yield. You know, so if you're investing 100 Rand, if you're sitting on 100 Rand, not investing, and inflation came out yesterday at 3.5%, next year, if it continues to be 3.5%, you will only be able to buy 3.5% less of your 100 Rand. So what's that? 96.50, right? That doesn't work for me, especially when things are going up. So what you want to do is invest your money in something that will generate above inflation returns, because you want that 100 Rand to grow above the 3.5% inflation that we have at the moment. I mean, I think now that I mean, these numbers are just crazy, right? So you can get a real yield in Brazil of 9%. In South Africa, it's just over 4% at the moment. And it's crazy to think that the emerging markets is where you're going to make real money, especially as we've historically, as South Africans, tended to want to send our money offshore and invest in hard currency. But I think it's important to remember that money flows to the higher yield. So if you're offshore, or if you're an international investor and you're trying to decide where to be invested right now, the last place you'll want to be invested is Japan, because you're getting a real yield of 0.12%. You're happy to invest with Brazil because you're getting 9%, I mean, like 8% difference, basically. The same applies for South Africa. And I think, of course, there are lots of other aspects of investing, like liquidity and currency and politics and all sorts of things, which investors do take into account. So it's not all a big rush to Brazil, but there definitely will be some flows going in there. So back to your ideal portfolio. Each of you would have answered the questions that I asked in the beginning very differently. So I had to go with what I thought would suit my requirements, which a lot of you will also have. I think, I've already got a pension fund. So I want to see, if I had R1 million right now, if I had R100 right now, I want to see decent growth and income return. So I'm 55 years old next month, and I know that I'm coming up for pension, and I'm going to want to use that money when I start earning an income. But for the years that I'm still working, I really want this money to grow quite a bit, which means that I really have to take some risk. So my investment horizon is actually not 3 to 5 years, but I think most people's investment horizon, or what we can comfortably sit with, is 3 to 5 years. And so I chose 3 to 5 years of investment horizon. I'm looking for growth and income. I don't need a pension fund. So this Regulation 28 story is a pension fund regulation. So I'm going to invest outside of pension fund Regulation 28, which can be a little bit restrictive at times. It really has its limits in place for riskier assets and local versus offshore. But I don't want to be restricted by that because I already have a pension fund that's sitting there. I'm full of little ditties, and the other one to remember is that you want your assets where your liabilities are. Withdrawing and spending pension fund money must be considered a liability, right? You're not investing, you're not growing this pot. That your investments sit on the asset side of your personal balance sheet. So although we often talk about diversification, I also want to remind you not to diversify your returns away, and also to manage that currency risk. Okay, so now we've got a nice little idea of where we're going, where we're skating towards. We want high conviction for our portfolio, for a South African investor, I'm assuming. I want to take risk. I'm looking for high total return, so growth and income. I'm looking for a 3 to 5 year investment. I don't want to be restricted by this Regulation 28. I want a nice clean portfolio. I want moderate exposure to offshore, because who knows where the rand's going. And I want full flexibility. I want to be well diversified. And this is the result. So from a strategic asset allocation perspective, I'm not choosing underlying shares. I'm just saying where you need to be, which asset classes, which regions you need to be invested in. I suggest you need 62% in equities if you're answered the questions similar to the way I've answered them. So 62% in equities. Of that, 38% is local, 24% is global. You need 18% in fixed income and credit. You need 8% in listed property, South Africa and global is fine. 9% in alternatives. This is a nice one to discuss after the crypto chat. And then I'd say 3% in cash, just for liquidity purposes and a bit of dry powder. Okay, I'm going to segue a little bit. So before I get onto the next serious topic, I must share with you something I found out only last weekend. Can you actually believe that? The term emerging markets was a marketing trick. I mean, who would have thought? We use it so carefree these days. So much like diamond engagement rings, which really only became mainstay was made mainstay by De Beers and Hollywood. Many of you will know the Moulin Rouge version of Diamonds Are a Girl's Best Friend, but actually the original song was sung by Marilyn Monroe in 1953 movie Gentlemen Prefer Blondes. Before that, before 1953, the diamond engagement ring was actually reserved for only a very few royalty. And I know my mother calls me a princess, but there's no way I was going to get a diamond engagement ring. I feel like I can hear female hearts around the country breaking and men sighing a sigh of relief. So, look, don't get me wrong. I love marketing. Those people made having cake for breakfast okay by calling it muffins. So, back to 1981. This guy, Antoine van Achtmael, who was working for the IFC. So the IFC is the finance arm of the World Bank, renamed the IFC's Third World Fund the Emerging Market Fund, which was very clever. He thought the new terminology conveyed growth and momentum rather than poverty and despair. Third world versus emerging markets, I say good for him. Okay, before I get back to your ideal portfolio and what each allocation should deliver, I want to show you the mathematics of compound interest. So I'm doing this in a bid to convince you that staying invested in the market is super important. I'll start by showing how simple interest works and then move on to compound interest and compare the results. Those of you who've only got this playing in your background, turn up the volume. Let's get on with it. So let's say you start with 100 Rand and invest it in a fund that returns 100% for the first period. After the first period, you will receive, let's say 100 Rand. And so now you've got your first 100 Rand that you invested, the original, and you've made a profit of 100 Rand or $1. Then you take your profit of 100 Rand and put it under your mattress or buy a pair of shoes. If you can find a pair of shoes for under 100 Rand these days. Look, I often do this in face-to-face conferences or seminars, and I use Smarties. You will not believe how many people struggle not to eat that one Smartie they've withdrawn from their investment account. So I know this is going to be hard, but bear with us here. So you withdraw your 100 Rand, you take your original 100 Rand and invest it for the second period. Okay, so now we've got the first 100 Rand and we've taken out the second 100 Rand. But again, we assume that you're going to make your 100% profit in the second period. Same story. You can now take that out of your investment account and put it, I don't know, under your bed, eat it, buy a pair of shoes. Okay, so we've taken it out, as you can see on my sheet on the right-hand side of your screen. You repeat this for the third period, investing the original, earning another 100% again, and so you go. By the end of the fifth period, you have a whopping 600 Rand. You started with 100 Rand, you made 500 Rand. You can use the multiples if you want. Assuming, of course, you couldn't find a pair of shoes for the 100 Rand, you just kept all the profits under your mattress. Now the interesting one. This is the really fun one. Moving on to compound interest. Imagine you start with the same 100 Rand. And after the first period, you've made 100 Rand. Except this time, instead of taking the investment out of taking the 100 Rand profit you've made out of your investment, you reinvest or you leave it for the second period. Again, it returns 100 Rand. And so, 100%. And so instead of ending up with 100 Rand and one taken out, you've now got 400 Rand, which you can reinvest for the third period and make your 100%. I think I'm going to pause here just for a few minutes to give the mathematicians in the room a moment to calculate what you think the total amount you are left with at the end of the 5 periods. I can't really see the chat. I'm going to try and find it to see if anyone's going to attempt to reply to us. Really not doing very well with 2 screens and. Okay, so I'm sorry, I can't see who's replying. Let's see. Okay, but here's the crazy part of this. I'm not sure how many of you figured it out by the end of the 5 periods, that you would have 32 dots or 3,200 rands compared to the simple interest investment where you only started with 1 dot or 100 rand, it ended up with 6 dots. I mean, like I had to move it onto different parts of the screen just because there were so many. So the other thing you'll notice is that I didn't say 5 years. I said 5 periods, because actually it's pretty ridiculous to expect a consistent 100% return per annum. I mean, that's just Ponzi scheme stuff. Can I show you how to figure out how long and what return you need to get that 100% return? In other words, how long will it take to double your money? So this is something we call the rule of 72. Again, turn up your volume and pay attention. This is an important slide. It's so simple, and yet so many people don't know it. So if you want to know how long it will take to double your money, this is the formula. 72 divided by the rate of return gives you the number of years. So for example, if my rate of return was 12% per annum, right? 72 divided by 12 gives me 6 years. So if I'm getting 12% per annum, which is less than the South African market has returned in the last 10 years per annum, by the way, so you have to be invested in equities, it'll take me 6 years to double my money. It works in reverse as well. So what rate do I need to double my money in, let's say, 5 years this time? Using the rule of 72 divided by 5, I need 14.4%. Now, I didn't choose that number coincidentally, because actually in the last 10 years, on average, the market has returned about, actually more than that, because last year was such a crazy return year for all of us. Okay, so back to our ideal portfolio. This is the result of what came out of my answers, and I want to break it down very quickly. So why and how? So now let's just look at the first section. So the local equities, right? The reason we got this is the equities part of your portfolio is really the primary growth engine. And we were going to put 62% of our portfolio into these equities. And the reason for that is we want a real high rate of return, and we want dividend yields, and we want valuation support. And we'll get to this in a minute. We want quality, cash generative, dividend paying stocks with nice cyclical upside. Perfect timing, because structurally, South Africa is very undervalued at the moment versus its global peers. So we're going flat out South African local equities in the money in the funds that we manage, the balanced funds that we managed. There are some companies with really good high dividend yielding. I think this year, what you'll see is, especially the gold stocks, because gold has rallied so much, the gold companies that are reporting now, and you would have seen some of them yesterday, like DRD, the free cash flow is just crazy. And so they'll be paying some nice dividends because they're not going to buy other gold companies because it's too expensive at this stage. And then, of course, we want cyclical upside for 3 to 5 years, right? So higher risk, shorter, medium term. The offshore global portion of our fund is 24%. I like this part because it gives me structural growth, currency hedge in case the rand bombs out, and style diversification. There are some stocks globally that you can't necessarily get in South Africa, and you want to be able to invest in those quality companies. So yeah, be selective, look for the income. So those are your primary growth. That's the primary growth engine of your portfolio. Then we've got 18% in fixed income and 8% in listed property. And this is the income and stability part of your portfolio. So here you want a reliable income, you want drawdown protection, just in case the equity market does come off, which it's inevitable. Nothing goes up in a straight line. And you want a little bit of capital preservation here. You want high income, inflation protection, re-rating potential, as I've shown you in South Africa, if our equity market re-rates, we're all in for a jolly good time. And then I've just seen my team message me on the side saying, Sasol's up 12% today. Yes, I told you South African shares. Anyway, back to my presentation. And then alternatives. In the alternative space, we're talking cryptos, hedge funds, private equity, anything that's not listed equity, fixed income, property, the ones that I've shown you. So the idea with alternatives is that they are non-correlated to the other stuff we've just seen, the equities, the fixed income, the listed property, the global equities. And so it should, if the market comes off, which it inevitably is going to, these alternatives should offer you a nice hedge or downside protection. So all it's really doing, not all it's really doing, it could generate a lot of alpha as well, but it also smooths your returns. Like if you may not have had access to it, because the problem with alternatives is liquidity. So what we call it in the industry is risk-adjusted return. So it'll improve your risk-adjusted return. So you're not having this volatility. And also, it reduces reliance on equity beta, basically the market. So instead of just following the market like you would with a passive fund, this alternatives and active equity, fixed income, and listed property and global gives you what we call alpha generation and not just beta. And then cash, 3% in cash. I think this is just dry powder, right? If there's an opportunity that comes up that you weren't expecting, I bought some in my Easy Equities account last year. I bought some Optasia when they listed, and because I had dry powder, I didn't have to put more money into it. I just transferred the cash I had into the IPO. I mean, that's the great thing about working with Easy Equities. Like you can do almost anything on that platform. So the cash is really your liquidity. It's tactical, it's flexible, it's a nice volatility buffer, and opportunistic capital, basically. So risk profile, we talk about risk. It's so much technical jargon that I kind of had to put in there. This is in plain English, So for the ideal portfolio, expect short-term volatility. This is not a conservative portfolio. If it's conservative that you want, then you need to think about being in something like the money market fund, which will give you a nice consistent yield. It doesn't have the volatility of returns. The mandate is really, primary mandate, I should say, is capital preservation. The drawdowns here, potentially in this high-risk fund, could be big, as I showed you during the first month of COVID in March. The equity market was down 30%, and I think it took a year before it got back to that level. And if I remember correctly, it was 18 months where it had doubled from the original levels. So talk about volatility. If you want that, if you can stomach it, the equity market is for you. I definitely can stomach it because I know this is not an emergency fund for me. This is a fund where I want to grow my investments. And so often in South Africa, what happens is the closer you get to retirement, your financial advisor will advise you to go into less risky assets. But remember, your return will probably be a bit lower. And what I'm noticing in South Africa is that not many people have got enough pension funds to live comfortably after they retire. You've got to draw down this pension fund. And so actually, I think we need to rethink that model and maybe stay in riskier assets for longer than is traditionally kind of the South African norm, if you like. So in summary, this portfolio will give you a high total return. Maybe take a screenshot now. Because that's the focus we want, right? We want equity-led but diversified. I don't want I don't want to put all my eggs in one basket. I want strong income generation. So I've chosen some dividends and credit and property. Moderate offshore exposure, because I'm not sure what's going to happen to the rand this year. I want something that's more aggressive than a Regulation 28 fund. And it really is designed to outperform inflation by 5 to 7% over the full cycle, although, that's not guaranteed. I don't have a crystal ball, unfortunately, but this is how we would think about where we're going to skate to. I didn't put this in a slide. I couldn't show you the returns, but the Cartesian AM ETF on the Easy Equities platform, which you can win apparently, some money invested in, is exactly this. It's a high equity balanced fund, so it has a little bit of everything in it. This is my disclaimer. Because I'm fiscal regulated, I'm going to leave it up there. You need to read it carefully, please. Memorize it. There will be questions afterwards. Just kidding.
Thank you very much, Anthea. It's always fascinating listening to you. And Anthea shows again why people in the investment and the insurance industry really are the bedrock of what we do. Her smarts and her passion clearly shines through. I've been lucky enough to spend time with Anthea over more than a decade, and whether she's busy writing her latest book in a favorite restaurant, doing presentations, helping clients really make the most of their investments, she's always consistent. We really appreciate you taking the time to join us today, Anthea, and delighted with your actively managed ETF, and we wish you much success with all your other products. So good luck to you and the Cartesian team. Next up is another wonderful person within the insurance industry, again showcasing the diversity and the passion. She's known to many of us, Lizelle van der Merwe, head of the FIA. Now, Lizelle is so passionate about the industry that her son Connor recently did some work experience at brokers' offices, and Connor is adamant that he's going to be working in the insurance industry because of the great example that his mum set. Lizelle's helper's granddaughter is involved in a program that's sponsored by SASRIA, run by ISA and the FIA, and it just shows again the multitude of opportunities available within the insurance industry. So for those more information on these programs, check out ISA and FIA. So Lizelle not only always looks perfectly, is not always super smart, but she sits at the center, really, of regulatory conversations, often shaping these conversations long before the rest of us even get a circular. And I love how Lizelle and her team make these regulations relevant to all of us. She's going to give us an FIA industry update, what's shifting, what's coming up, and what all of us in the industry should be looking out for. Let's hear from Lizelle.
Good morning and welcome to InsureTalk. My name is Lizelle van der Merwe, Chief Executive of the Financial Intermediaries Association of Southern Africa. It has been an extraordinary start to 2026, and I want to share some insights into what the FIA has been doing for our members and industry at large, and why intermediaries will remain essential to the financial services ecosystem. I will be soon presenting at the GWII Leader Walk on the challenges and opportunities facing intermediaries, and the message that I'm bringing to the audience is this: intermediary businesses are not trying to survive. They are a critical market mechanism. With independent distribution, the entire financial services ecosystem is strengthened. Without intermediaries, there are fewer choice for clients, there's reduced competition, and there's less innovation. In times of economic uncertainty, professional advice becomes more valuable, not less. Clients do not need more direct product sales. They need interpreters, they need strategists, and they need advocates. This is the intermediary's competitive edge, and it is irreplaceable. At the FIA, we also don't just talk about the value of intermediaries, we fight for it. Over the past quarter, our advocacy work has led to tangible results. We saved the sector an estimated 10 million rand per annum through FSCA levy reductions. We've invested over 1.2 million advocating for fair employment equity targets for our subsector, because currently, as some of you may be aware, it is one target for a bank, an insurer, an asset manager, or an advisory business. We're pushing hard for subsector specific targets that are achievable and fair. We successfully advocated for changes to Omni CBR reporting, now Omni Risk Returns, moving from proposed quarterly reporting to annual reporting, saving FSPs time and money. We also participated in the G20 Social Summit, where we represented our sector on the global stage alongside our former Deputy President of South Africa, Dr. Phumzile Mlambo Nguka, and the Minister of Higher Education. The conversation centered on the role of financial services in terms of stimulating economic growth through education, skills development, and financial inclusion. And the FIA was at that table. And thank you to Dr. Kirshen and Gifts for making that possible. One of the most exciting developments that's been on our radar this year has been our engagement with the new African Financial Architecture Initiative, which is led by the African Development Bank and National Treasury. This is of particular interest to us because it really talks about reshaping how Africa finances its own development, in particular infrastructure development. It is also a great opportunity for intermediaries, as they will play a critical role in advising clients on new investment pathways, investment strategies, risk-adjusted opportunities, and an evolving financial landscape on our continent. In March, the FIA and CN&CO will be hosting the WFII in Cape Town. This is a wonderful opportunity to not only showcase our wonderful country, but also just to showcase the high quality of intermediary businesses and regulators that we have in South Africa. So this is a really exciting time, and we'll keep you posted on the outcome of this engagement. But to every other advisory business watching this video, 2026 is not merely a year to survive. It is the year to thrive. It's a year to claim the value you've always delivered. The FIA has your back. We're answering that call with renewed energy, sharper focus, and an unwavering commitment to you. Thank you for watching, and thank you, InsureTalk. Goodbye.
Thank you so much, Lizelle. It is great to get the update from such an important role player in the industry. And what you and the FIA team have been doing, continue to do, is hugely appreciated. So thank you very much, and we look forward to sharing lots more insights from you and the team at upcoming insurance talks. And good luck with all your family getting into the insurance industry. Next up, we're on a run here. We had the brilliance of Anthea, superb Lizelle. And next up, we've got another passionate, smart, superb woman in the industry, Rianette. As we know, Rianette is best known for her role as the owner and editor at FA News. But more than that, I think Rianette and her team have taken the industry by storm with the Insurance Apprentice. So if she's not talking to brokers, visiting underwriters, selling insurance to our country as the industry to be involved in, she's playing golf, beating most of us, and just flying the flag high for insurance. So let's get an update from Rianette.
Hello everyone, and welcome to the first InsureTalk for 2026. It is great to be back from my side. Thank you once again for the opportunity. I really appreciate it. So there is a lot happening right now in our industry, in our businesses, and definitely here at FA News and the Insurance Apprentice. So today I want to give you a quick update, share a few highlights, brag a little, and hopefully leave you thinking about where 2026 is taking us. Let me start with something I'm incredibly excited about, and that is TIA 2026. Season 12 of The Insurance Apprentice, Season 2 on television, and I want to say that this might be one of the best, or maybe the best seasons we've ever produced. We've partnered with a new production company with deep experience in reality and game shows, and it shows. The pace is sharper, the storytelling is stronger, the production quality is on another level. We've also moved to E Extra, airing Saturdays at 18:40, so 20 to 7, with a Sunday morning repeat at 10 o'clock. Proper prime time exposure. So yes, we will still be on YouTube, but I really want to encourage everyone in this industry to get behind it. This is our industry on national television, and this is consumer education at scale. We also have a brand new host, Tapelu Mokoena. If you know Tapelu, you know this is a serious step up. He brings presence, credibility, and reach. He'll keep viewers connected and engaged throughout each episode, and we believe that that will translate directly into higher viewership. Filming is done except for the finale, and the contestants this year are strong. Big personalities, real ambition, and some incredibly powerful sponsor-driven tasks focus on practical consumer education. Big shout out to Sazria, who is once again our headline sponsor, and a bigger shout out to my judges, Simon Coleman and Nax Lamini, who you might actually like this year, but let's wait and see. The first episode is on 2 May. We'll share more detail as we get closer, but this is definitely one to watch. Then let me just brag briefly about FA News before I go over to the content. Pulled the FA News website stats the other day, and it was amazing to see the following stats. 2.6 million page views, 1.7 million user engagements, 770,000 sessions that starts, 500,000 first-time visits, and over 81,000 downloads. When you look at what people are actually reading, it's even more telling. Our CPD-related pages are pulling in serious traffic. One page alone sitting at over 430,000 views. Our login and registration pages are high. Our homepage remains strong. People are coming, and they are coming back. For a niche industry platform, those numbers is impressive, and I think it's something we can be very proud of. So, but what excites me even more is that people are reading, right? Which takes me to what we have covered in the February edition, which has just been uploaded. We unpacked the 2026 insurance regulatory outlook and what upcoming changes mean for brokers and insurers operating under increasing governance pressures. We explored the co-insurance paradox, what's really happening with capacity and claims, and how they impact placement strategies in a pressured market. We explored the co-insurance paradox, what's really happening with capacity and claims, and how that impacts placement strategies in a pressured market. We looked at the unexpected claims that make insurance stop and rethink assumptions, because often the outliers reveal the blind spots. We examined what leadership looks like in the age of the unquantifiable, where geopolitical instability, climate volatility, and emerging risks don't fit neatly into historical models. On the technology side, we asked the tough questions, how data analytics and AI are redefining predictive underwriting, and how climate and cyber risks are driving real innovation in product design. We also explored new risk segments, including insurance solutions for creators and influencers, because the risk landscape is evolving faster than traditional underwriting cycles. And importantly, we looked at how Africa can harness financial inclusion as part of addressing climate risk, because resilience on this continent will require inclusion and innovation. Another discussion that stood out recently was a session run by I2 where Justin Naylor unpacked how global tensions are shaking the foundations of risk and underwriting. This wasn't theoretical, it was a real unpacking of how geopolitical instability, trade fragmentation, and supply chain disruptions are now directly influencing underwriting decisions. And the message was clear: risk is no longer just actuarial. It's geopolitical, it's systematic, and it's behavioral. We are no longer simply pricing the past, we are underwriting uncertainty. And that requires a very different mindset across the industry. Now, speaking of mindset shifts, let's talk about hybrid working. The latest Rent Channel 2025-2026 EB guide shows that hybrid is no longer an open-ended flexibility experiment. In 2023, just over 40% of hybrid organizations required employees to be in the office at least 3 days a week. That number has jumped to 67%. Hybrid is becoming structured, measurable, prescriptive. Employers are refocusing on accountability, collaboration, and rebuilding organizational culture. At the same time, they are repricing the employee benefit and the employee value proposition. Sign-on bonuses have dropped sharply from over 50% of employers offering them to under 30% currently. Employers are no longer rewarding promise, they are rewarding performance. Other interesting shifts that we've seen in that survey: 13 checks are declining, fully paid extended maternity leave is declining, but earned wages access programs are increasing, giving employees structured access to wages already earned rather than encouraging debt. The core question employers are asking in 2026 is not what more can we offer, it is what value can we derive and defend for every rand we spend. And that question matters deeply to advisors and brokers in the EV space. If hybrid policies are tightening, if incentives are being recalibrated, if performance must clearly justify reward, what does that mean for how we structure advice? We'll be running our own survey on this soon, and suspect we already know what the sentiment out there is. But let's engage properly. The survey will be fairly informal, and it is really about the hybrid working environment. So, because 2026 is shaping up to be a year of recalibration, regulation is evolving, risk is globalizing, technology is accelerating, work models are tightening, and performance is under scrutiny. But here's what I find encouraging. Our industry is not passive. We are educating consumers on national television. We are debating difficult themes. We are innovating, we are adapting, and we are reaching millions while doing it. That is something to be proud of. So as we move further into this year, watch TIA, read FI News, engage with the survey when it launches, and keep asking yourself, where is the opportunity in this pressure? Because 2026 is not slowing down, and neither are we. Thank you for the time, and enjoy the rest of your session.
Thank you so much, Rionette, for always keeping us updated on what's going on in the industry. Now, next up, we've got a real treat for you guys. I'm going to introduce my colleague, Veronique van Rensburg, who's the Easy Equities Head of Education and sometimes Entertainment. Veronique is part of the Easy family, a gem that we found in COVID, when stages went quiet and artists were out of work. She's joined our team, and hiring her has come with a very cool bonus, one of the most powerful and versatile voices in the country. So she's going to treat you to a little entertainment now.
Así pasan los días y yo desesperada y tú contestando, quizás, quizás, quizás. Siempre que te pregunto qué, cuándo, cómo y dónde, tú me respondes, quizá, 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 quizá. Pensando, estás perdiendo el tiempo. Pensando, pensando. Y así pasan los días y yo desesperadamente pensando también, también. Siempre que te pregunto qué, cuándo, cómo y dónde, tú siempre me respondes, quizás, quizás, quizás. Estás perdiendo el tiempo pensando, pensando, por lo que más tú quieras. ¿Hasta cuándo? ¿Hasta cuándo? Estás perdiendo tiempo pensando, 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 pensando también, también.
Hi.
I've got a little story to tell, a tale of hope and inspiration now. Come gather round, 'cause I know it well. Will you believe me if I show you how we took a dream in a world that told us no? We never let go, can't let go when it has to grow. This dream was the spark that lit 1,000 more, and they light up the path to what we're striving for. We're striving for freedom, peace.
Thanks so much for that, Veronique. I think next time we need to do that live as a duet. I'm going to hold you to it. Up next, guys, we've got Rish Tandapani, Easy Equities Group Chief Operating Officer. Rish has led operations across multiple global markets, aligning teams across continents, time zones, and regulatory environments, and making it look seamless as he does. He's sharing an overseas perspective aimed at operations leaders and why cohesion, culture, and clarity matter even more when you're scaling globally.
Thanks, Carly. Thanks, Carly. Good afternoon and good morning to everyone. Not sure how I follow Veronique, but I'll endeavor to do my best. Just a bit of housekeeping. I've put my details in the chat in case anyone wants to reach out with any additional questions which I don't cover today. And also, please put your questions in the Q&A, and I'll dedicate about 5 minutes towards the end to covering all of them. Good morning. I'm Rish Tandapani. I'm the COO of Easy Equities and Purple Group. I'm going to try and give you guys a kind of practical, funny, kind of data-grounded and honest approach to this whole question of global operations. And for those of you who don't know, I'm not South African, but I'm going to try and tie this back into a kind of South African ethos and kind of what is inspiring about working and leading a team in South Africa. So maybe for some context and to give you guys a bit of perspective on where I'm coming from, I've spent 15 years working across, I think it's 8 markets in total. It says 6 there. When I calculated this morning, it was closer to 8. And obviously now I'm based kind of in South Africa, kind of in Singapore, looking after Easy Equities and Purple Group. But over my career, I've touched base in UK, where I'm from, Hong Kong, Philippines, pretty much all over Asia and the Middle East. And one thing that I'm really sure about is the way we should lead teams across, retail segments and across the global time zone. At Easy Equities, we've grown our client base to over 100 billion in clients' assets under management. And a big part of that story is actually the operational infrastructure that we've built across time zones. And here's really what distance has taught me. Leading from overseas actually sharpens my focus. It enables me not to take things for granted. When you can't be physically there, you stop trying to supervise and start building systems. You shift from control to culture. And from proximity to alignment, which I think is a crucial thing, especially with some of the comments some of the other speakers made about being a more remote global workforce that everyone is having to entertain at the moment. But through it all, through every market, every time zone, every operational decision comes back to some kind of core identity. And in the case of Easy Equities, and in the case of myself now, it's a South African identity. It's non-negotiable. So what does really distance kind of teach you as kind of middle managers and employees? So let's kind of be blunt about everything. You can't really micromanage across time zones. It really doesn't work, and you shouldn't really bother trying. I learned this the hard way, whether it was in Manila or London or Singapore. Someone in an Asian time zone finishing their day while someone in your Joburg time zone or South African time zone is starting there. You can't really have everyone looking over everyone else's shoulders. And people see that as a bad thing, but it's actually a blessing. And it comes down to one key kind of consideration, and that's trust. And trust becomes your most valuable currency in this type of organization. Not necessarily control, not oversight, but trust. You have to hire people who can make decisions and give them the context and guardrails that really allow you to get out of their way and just get on with things. And I think this is a kind of common theme that we're going to see over the next 2 to 3 years, where organizations really treat trust as a key KPI over control and over oversight. For me, documentation is critical. It beats tribal knowledge every time. In a co-located office where you're all together, you see each other every day, you can kind of walk over and ask someone how something works. In distributed teams, you can't really do that. If it's not written down, it really doesn't exist. And the idea that you could have some kind of water cooler conversation actually doesn't do justice to the aims and KPIs that you're trying to build. this forces clarity that actually makes your operations stronger. And if you think about the use of AI, which I'll get onto later, and a lot of people touched on today, the thing that makes AI better is clarity, okay? And the thing that makes your operation stronger in the long term will be AI. And finally, the kind of final point I put there about culture eating strategy for breakfast, it's so true, you know? Actually, especially when you're working remotely, when people aren't physically together, culture is what holds them together, okay? Your values, your communication style, how you celebrate wins, how you handle failures, that's really what binds all these kind of distributed and remote teams. And some numbers for the audience, which I think is also kind of important. We're living in a very data-centric world, and a couple of the last speakers talked and actually quoted some of the numbers I'm about to show you guys. 16% of operations professionals feel adequately trained in AI. And it's kind of madness. Maybe 4 years ago, I would have probably expected that type of number. But given the cadence and the acceleration of AI, I think that 16% of operations personnel, and I've litmus tested this with my own team, feel that they've been adequately trained in AI is crazy. It's a striking number. 63% doubt AI will boost their productivity. That's interesting. And spoiler alert for everyone, you know, they're completely wrong. And I say that not theoretically, but based on what I'm seeing on the ground. AI does boost their productivity. Those who say it isn't are either very defensive about the roles that they're doing, or they don't really see the bigger picture of kind of what's going on. But for me, the interesting part in all these stats was this 55% believe in AI can help them achieve objectives more effectively. So there's genuine hope at the end of this tunnel, right? People do see the potential. I think it's managers' jobs in particular to see the potential. They just really don't know how they're going to unlock it yet. And that's something I think I can kind of help you guys navigate later on in the conversation. So what's the real challenge here we're talking about? It's really about training to ensure that the AI velocity that we're currently seeing is managed and we're keeping up to speed. We can't stop operations to retrain everyone. It just doesn't work that way. But we also can't fall behind. Okay, so this is a kind of tightrope that any operations leader, remotely or on the ground, really needs to kind of navigate well. For me, I think another clear kind of point that I think gets lost in translation is this idea of communication. It's weird because you kind of feel that when you automate more things, or you're introducing AI to do more things, that the need for communication is somewhat diluted. It's actually the opposite. And I just want to make something very clear. Communication to me is an infrastructure. It's not really a soft skill. Treat it like a system, invest in communications like you would in a system, and hold people accountable to it like you would in a system. And if that's enforcing people to communicate and essentially write emails and SOPs and staff announcements, etc., I think that's the way to go. From my perspective, having worked across multiple time zones, kind of async communication beats sync communication every time. It's just the way the world works. I'm 6 hours ahead of you guys now. Some of my team are 8 hours ahead of me. It just works that way. So any kind of asynchronous communication, whether that's written updates, recorded videos, well-structured documents, things like that, they beat live meetings for most things, especially with a remote team. You cannot build a global operations team on Zoom. It just doesn't work that way, okay? Someone is always sleeping, someone is always commuting, someone is always in the wrong time zone. It's just not going to work. I think one thing I've learned in particular in the last 6 months that I think is very, very prevalent because of this assumption that everyone knows everything is that over-communicating context is massively important, okay? Under-communicating urgency is also massively important. So give people the full picture so that they can make the good decisions without you in the room, okay? Don't create this false sense of urgency where everything is marked urgent because ultimately nothing does become urgent. Slack and email hygiene matters more than you think. Be clear with your subject lines, threaded conversations, tagging the right people. It's not about being pedantic. It's about survival, right? It's about making sure everyone's on the same boat at the same time and everyone's aware of everything. Bad communication hygiene in distributed teams, so in global remote teams, actually compounds real operational failures. Because what you can actually say is, well, I'll deal with this tomorrow, or I'll get clarity on this later on in the day. And as per normal, you don't really have the luxury of doing that and things fall behind. And I think for me, kind of regular FaceTime virtual or physical for me is non-negotiable. People have asked me now for 4 years, having worked for Easy Equities, how do I maintain kind of sanity and communication with my team? We do weekly syncs, we do quarterly kind of in-person gatherings when I get there, or when I go to one of our remote satellite offices. You need the high bandwidth human connection. Okay, that's just mandatory. That's only how real-time interaction, and that's only something that can be provided with real-time interaction. But the async communication is actually what gets the work done. And I think it's important that you understand that balance between the two. So I know everyone in the room is probably wondering what's my take on AI and how has that helped both insurance, which I'll get to later on in the presentation, and specifically operations. AI is my new favorite employee. And let me tell you why. Kind of at Easy Equities, we're using AI to automate our compliance, do reconciliations, control checks across all these multiple jurisdictions. And what used to take my team of people kind of days or weeks now happens in real time, around the clock, without anyone really losing sleep over that. And that losing sleep over it is a really important point, because it gives you mental bandwidth to go and handle other tasks or more priority issues. We have this ability now to kind of real-time detect things, whether that's anomalies in processes, whether that's frauds. We catch the issues before they actually become problems. And again, if the utilization of AI is across multiple time zones, it just makes the problem go away faster. AI doesn't get tired. It doesn't take coffee breaks. It spots patterns that humans simply miss at scale. So integrating AI into your operational framework and into your operations team, I think, is mandatory. And if you haven't started doing it now, then you're already probably 6 to 9 months behind. But one powerful thing that I found when we started using AI at Easy Equities was this idea of predicting my staff models. And what does that actually mean? I can really tell you what my staff are doing before they do it. Okay, whether that's based on pattern recognition or analyzing their schedule. And I'm not trying to say this in a kind of surveillance way, but we can really predict workflow volumes and resource requirements in a much more really accurate way than we were before. And that helps planning massively. So this idea of predicting staff models and using AI across the globe to see where maybe the majority of your employees can sit, whether it's an outsourced activity, whether they sit in the Philippines, whether they sit in London, South Africa, I think we get to gauge that more powerfully now. And I mentioned it earlier, but just a statistic for all of you, my team have been able to convert in the last 1 year 360,000 hours of document processing into a matter of seconds. Okay, and that's not an exaggeration. We've tested that. We've seen the results. Easy Equities as an example, when we onboard a new client, it used to involve significant manual documentation verification, risk profiling, feature checks, etc. Today, we've incorporated AI to parts of that so that it handles the bulk of that in seconds. And as that AI cadence and trajectory moves forward, we're talking about seconds becoming even faster. And I think that's important for any operation infrastructure to keep up with. And let's just get one thing right here. AI isn't really replacing people, okay? It's helping amplify their judgment. It's helping freeing them up to focus on work that genuinely requires human insight. So this idea that it's a give or take isn't really there. I haven't seen any specific cases now where it replaces people. It just enables my staff to do other things that add value to the bottom line. Speaking specifically of operations, where has AI kind of helped my operations? Definitely in the kind of goal setting and planning area. I've been able to get much more conformity and coherence with my team in terms of analyzing whether that's their past performance, certain market conditions around salaries, things like that, resource constraints. All those decisions are surfaced faster and better with the use of AI. We're also reducing the amount of manual errors, obviously, in our data management. I think that's across the board, and insurance in particular, where you get, it's kind of an unglamorous job, if you like, but massively essential for both operations and insurance operations. Client records, product data, regulatory filings. AI catches the errors humans make when they're tired, right? When they're under pressure. It deals with volumes that were never designed to be handled by a human before. So I think that's another kind of clear win on the AI side. And as I mentioned earlier, just from a pure fraud and kind of AML perspective, in the insurance service and wider financial services, this is becoming critical. Identifying suspicious patterns across millions of transactions, fraud and AML risks, and the participants in those are getting more sophisticated in their use of AI. So obviously, organizations and operational teams need to make sure that they're always one step ahead of the rogue agents. So again, as I mentioned earlier, I don't think it's a case of replacing people. I think it's a case of really kind of amplifying the judgment of the people I already have. The AI flags the anomaly. The human really does decide what to do about it. And we will get to a stage where that's kind of more of an equal balance. But for now, we're living in a kind of reasonably good harmony between the technology and the people. And I think an important thing for those of you who are looking to build out AI in your teams or use it in your day-to-day tasks, that partnership, that balance between AI and the person needs to be the right model. And I think at Easy Equities, we're kind of finding a good balance for that and working towards the right thing. As I mentioned earlier to some of you, I'm not South African, and I've spent the last 4 years kind of immersing myself in kind of South African identity, and not just from a professional point of view, but also from a kind of personal point of view. And that's important because ultimately your company is founded and your company is headquartered in one jurisdiction. And the identity you present to the rest of your organization is important. And one thing I've learned working with South Africans kind of 24/7 for the last 4 years is that really this idea of being resilient and, that level of complexity, South Africa has one of the most demanding regulatory environments, whether that's, the FICA or SARB. If you can build and operate compliantly in that environment, you can really do that anywhere, all right? It's really not a limitation. It's actually more of a training ground. And when I explain this to non-South Africans or teams outside of South Africa, this idea of the resilience that is forged from operating in a South African environment is super, super critical, And, I threw in this phrase, the Ubuntu philosophy here. And, this is something that someone mentioned to me about 3.5 years ago. So it isn't just a cultural reference for me. It's a real genuine operating kind of philosophy. The collective success is really going to overshadow the individual heroics, okay? And organizations that progress and move fast and are agile are collective successes. They're not just a band of individuals trying to push the team forward. So lifting your team when they're struggling is an important ethos, showing that resilience. And that ethos will travel over time. It may not happen in 6 months. It may not happen in 1 year, but over the course of time, whether that's a Singapore where I am, or a Manila or a London, that ethos really does travel. And I think the other thing that I've learned in building an operations team from South Africa, but kind of globally, is this idea that pragmatism is more important than perfection, okay? One of the great learnings I got from our CEO, Charles, was this idea that, we don't need that perfect model straight away. We ship, we iterate, we have MVPs, not perfect solutions. And Easy Equities was built on that exact principle. Whether you're democratizing investment for ordinary South Africans, you really can't have that finished product because that's a continually evolving process. So we launched, we listened, we improved, and then we launched again, okay? And sometimes we failed, and then we launched again. And that pragmatic, iterative mindset is baked into how we really run our operations globally. It's nothing more sophisticated than that. If we move faster than organizations that way, we're likely to do better than them. And I think that's shown across the globe. We're also just building for an emerging market, which is something that is underlooked. South Africa is still very much an emerging market, not a fully developed one. So understanding the infrastructure constraints, the kind of mobile first realities, the kind of ingenuity required when resources are limited, that hones and sharpens your operations everywhere. So when it comes to about it, I think it's important that your local teams own execution, full stop, okay? You can't try to have a helicopter vision where, the global outlook is managed, the execution and strategy of that is kind of managed in one place. Local teams, they know the market, whether that's a team in Singapore or a team in China or a team in India, and they will know that better than a South African team. And vice versa, a South African team will know their local market compared to somewhere else. And my job is really to kind of set those guardrails, right? whether those are brand guidelines or operational guidelines, risk limits, and we trust the local team to execute. And again, to the point I made earlier, micromanagement from 6,000 or 8,000 kilometers away, that's just going to breed resentment. It's not really going to breed progress. Central standards, local flavors, I think that's kind of self-explanatory. The kind of what is central, if you like, the how can be local. And I think my teams have picked up on that very, very well. I think also having this idea of regular audits is important. You don't want to create an overly bureaucratic environment, but quick structured check-ins, not heavyweight investigations. The goal is to catch small issues before they become large ones, right? It's not to create a culture of fear. And we've done a reasonably good job of that at Easy Equities. I think you have to really celebrate local wins as well, okay? Whether when a South African team develops a way better process to our Manila team, it is what it is, and you celebrate that, and our Manila team learns within a week. And it's important that this kind of cross-pollination of ideas and failures, in some cases, across all the operations, is actually one of the kind of strategic advantages that I think my team has, and other kind of global operations teams can have. So let's kind of bring this back to kind of real world now. Where are we all kind of operating now? And I wanted to kind of give everyone a bit of a kind of digest on how I look at the world and what I'm thinking about. Obviously, there's this huge geopolitical disruption that we're seeing. It's affecting supply chains, talent in ways that really weren't on anyone's operational roadmaps a year or two ago. We weren't talking about wars and trade tensions and regulatory fragmentation. We weren't doing all those things. So this is really a new baseline. And I think as effective managers and leaders and employees, you need to see it as a new baseline and not necessarily a kind of temporary disruption. I think there's also a critical operational framework that needs to be kind of talked about in guys, which is this idea that, budget constraints are there versus these kind of transformation expectations. Every leadership team wants digital transformation. Everyone on this call, I'm sure, wants digital transformation. And they want that with AI integration. They want operational excellence. But the budgets haven't kept pace with the ambition, okay? So we're being asked to do materially more with either the same or less. And that's why AI is such a kind of enigma in this whole thing and could be a huge catalyst for change. So that means making hard choices about, what we want to prioritize versus what we can shelve for 6 months or a year. I think the other kind of important thing in the insurance space, and we're seeing this very much in the brokerage space, is this kind of rising customer expectations. Okay, customers now benchmark their experience locally in South Africa versus global names and global brands, whether that's a Netflix or an Uber or Robinhood or whoever. They don't really care that you're a regulated financial services business with legacy infrastructure. And I used to use that phrase so much in my day-to-day, legacy infrastructure. Expectations have moved at a client level. And as a result, organizationally and operationally, I think we need to catch up. I also think there's this idea of kind of skill shortages that we're not talking about. The people who can do this kind of work are kind of scarce and expensive. So building that capability internally is essential. Not every answer is going to be looked for someone outside or someone who's got 10, 15 years of domain knowledge. So hiring your way out of the problem isn't really viable for most organizations. These are just the realities. As an operations leader, I face them constantly and try to be creative in how I work within those constraints. And more often than not, there are internal choices which you can look at. I just wanted to touch on kind of insurance from an operational standpoint. It's fascinating to see a lot of the speakers earlier today talk about this intersection of data and compliance and speed, and all those things are moving at like 1,000 miles an hour, and kind of how do we keep up? I think for me, when I look at the insurance section, I think in short-term insurance, the kind of moment of truth is when the customer makes a claim. How fast do you respond? How clearly can you communicate, and how fairly can you really settle? That's your brand, and really there's not much flexibility on that. The operational excellence that I'm managing for some of our projects is very much measured in hours, not days anymore. And so I think that velocity is going to be a huge thing going forward. I think fraud detection, as I mentioned earlier, at scale is going to be a big one. Insurance fraud is sophisticated. I see instances of of fraud in our system, multiple times a day, and from clients entering our ecosystem. And in the kind of short-term insurance space, that's going to be huge. AI can identify patterns across millions of these claims that no human could ever spot. So let's embrace that. And I think the final adjudication still requires human judgment, but that combination, as I mentioned earlier, is going to be massively powerful. And I think when I think about insurance, it's obviously heavily regulated, and those regulations vary significantly based on market. Operational teams now need to carry the burden of ensuring that every policy, every claim, every settlement meets those local requirements. That's really not a compliance team's problem anymore. It's more of an operational architecture problem. And I think that shift from seeing it as a kind of archaic compliance issue to seeing it more as a modern organizational operational challenge is going to be powerful to kind of solving a lot of these issues. And just the final point on digital transformation, it's really no longer optional. Customers expect to buy cover, file claims, receive settlement entirely digitally. So if you're relying on manual touch points, you're probably actively losing clients to competitors who've already made that shift. What am I suggesting we kind of change in insurance operations? This idea of AI now accessing risk and pulling relevant data points is important. Underwriting process that once took humans, or human analysis days, is now being compressed dramatically. And I'm building my teams around that new reality, whether that's a credit product, an insurance product, or something more long term. We're very much embracing that new reality. I think this idea of telematics is hugely important. If you think about it, we can now price motor insurance based on actual individual driving behavior, rather than demographic proxies. So that's fairer for the customers. That's more accurate for the insurers, and it fundamentally changes the data and the operations infrastructure required to support that. So think about the underlying data across the board. For me, critical, again, omni-channel experiences. Think about it. Customers move between apps, websites, call centers without thinking twice. They expect a seamless kind of consistent experience. The silos that exist inside insurance organizations are invisible to customers, so they shouldn't have to care about them. And it's the job of operations to kind of build that gap. And I think the final point, and Emil talked a bit about crypto earlier, but this idea of blockchain transparency and policy management is going to be a big thing. Whether you have immutable records, instant verifications, significant fraud risk reduction, blockchain is moving from proof of concept into a genuine operational deployment stage. And every insurance business should be kind of embracing that. Just a couple of slides before I take some questions. Let me leave you with some kind of guidelines or some things that I think have made a difference from leading a global operations team across the globe. Build rhythm. I think that's important. You can't. It's not a temporary job. You can't do this for 2 weeks and then take a week off. You have to have these weekly syncs to make sure everyone's aligned on priorities. I think quarterly in-person gatherings are massively important, even if that's hard and expensive to arrange. And that rhythm creates predictability. And the predictability is what really, from an operational standpoint, reduces a lot of anxiety across the time zones. Heavily invest in onboarding. I've spoken to Carl and his team at length about this recently, but cultural fit matters even more in remote and distributed environments. Okay, a bad hire in a co-located office is quite painful. A bad hire in a satellite team can be hidden, right? It can go unnoticed for longer and cause more damage. So really do take the time to onboard properly and set clear expectations from day one. Give feedback loops. I think that's critical and makes sense. And measure outcomes, not outputs. I really don't care how many emails were sent or meetings were attended. For me, what matters is this idea, is the business moving forward? Did the customer get a better experience? Did risk reduce? And outcome-focused KPIs and metrics are harder to define, yes, but infinitely more meaningful for organizations in the long term. And even at a personal level, for those of you who are kind of sole proprietaries or working alone, try to have outcome-focused metrics. It makes a big difference. Works for your health, works for your diet, works for your gym, also works professionally at work. Embrace AI pragmatically. I won't go on too much about that, but I think it's important. For me, documentation is an act of love. Sounds crazy, but make it easy for people to do the right thing without needing you in the room. Okay. sounds like you're devaluing yourself, but actually, ironically, you're adding more value to your ability to lead the team. Foster local leadership. Really, you can't have a remote, you're not building departments, you can't have a team on the ground without identifiable leaders. And I think that's a huge operational asset. And, excuse me, I think the final thing I'd say just before I kind of close is this idea of stay grounded in your ethos. And this is particularly important when adapting to local context. So your core values don't change. Okay, at Easy Equities, our core values haven't changed, regardless of the geographies that we are embarking on. But how we express and apply them, whether that's in a Singapore, Manila, Portugal, London, or Johannesburg, will look slightly different. And that's not inconsistency, right? That's cultural intelligence. And that's a very key point that I think needs to be raised. I think, yeah, just to conclude and to give you guys something to think about, you will join more Zoom calls at genuinely ungodly hours than you thought was humanly sustainable. I used to do it for a number of years. And, the rhythm that is acceptable, the idea that is acceptable is kind of madness, okay? And as we live in a kind of world of work-life balance and the importance of family and doing things outside of work, I think it becomes even more important. You will eventually become fluent in async communication out of sheer necessity. It's important. And yes, you will occasionally pause and genuinely not be sure which country you're supposed to be working in, but the rules and some of the ideas I've given you today will generally make it more worthwhile in the long term. You'll eventually, some of you will have ambitions to build teams that span continents and create impact. And that's possible. And you'll learn more about leadership, culture, communication than you ever did managing a co-located team. Rather than managing a co-located team and instead managing a distributed or global workforce. And your global perspective is important. It fundamentally makes you sharper, it makes you more empathetic, and it makes you a kind of more effective operator. So I hope that gave you guys some context of kind of what my life is, or a day in my life is. And, this idea that for me, distance has forced me to be clearer and have more purpose and execution. When you're not physically present, you cannot rely on presence to lead. So I think that's important. Embrace technology, remember your root of your home country, and operational excellence will kind of stem from that. So I hope that's all from me today. I hope that's been useful. I've tried to link it back to South Africa and chime in with some local ethos points, but happy to take any questions. Cool. So,
Thank you very much for all of that, Rish. We greatly appreciate it. And since you're 6 hours ahead of us, you can now celebrate with a drink. The rest of us have got a bit more work to do before we can get there. But always fascinating to get a bit of a different perspective, ex-South Africa, and whether you believe that AI is a threat or a bubble or is not going to impact you, whether you think it's the next best thing. Lots of useful food for thought there. So thank you, Rish. I think it is also important to acknowledge that of the many thousands of people that attend InsureTalk every month, a number of you are operational people. So often you don't get the limelight. You're behind the scenes, but the work that you do and how you do that work is absolutely essential to how we deliver our insurance products, our investment products to clients and how we make their lives better. So a big thank you and good luck with AI and how it impacts your roles going forward. So next up and closing us out for today's InsureTalk is a colleague of mine, Higo van Biljon. It's interesting, another colleague of mine, Almiro, when I'm in Johannesburg, I call him Almiro Oosthuizen and we speak English. When I'm in Cape Town, I said Almiro. And Higo is ook Higo. So it's interesting how in a work environment I seem to talk English. But Higo is not only an accomplished investor. He started investing when he was 13 years old. This oak is borderline fanatical about investment. Started at 13. He's exited a number of fintechs and other business ventures that he started. And he's now working at Easy Equities as head of product for Easy Retail, or Easy Retire on the retail side. Higo's going to talk a little bit about the future of financial advice, hybrid model, succession pressure, and why retail investors matter more than many intermediaries believe. At Easy Equities, we think that retail investors are a massive opportunity for investors, and both Higo and myself are very biased towards intermediaries and advisors. So really looking forward to Higo's presentation. And a little tip here, also check out your Spotify or Google playlist, because Higo is also an accomplished musician and has recently released another couple of songs. But let's see if his ability to talk to us about the future of financial advice is as impressive as he's singing. Over to you, Higo.
Thank you so much. Cool. Thank you so much, Carl. Appreciate the intro. I am known by Higo and Higo, but the birth name is Higo van Billon, so it is actually an English origin. So I'm the head of product at Easy Retire Retail at Easy Equities, and the three main parts of that is first, to oversee the current retirement products that we have, so retirement annuities, living annuities, etc. Second, we're building a new product for advisors called Easy Advisor, which is launching later this year. And thirdly is to see how we can make it easier for SMEs to allow their employees to invest towards retirement. So today I'll be sharing the future of financial advice, my views on it. And there's so many things I can talk about. There's compliance, there's admin, regulations, AI, young clients, older clients, succession planning, etc. So I'll touch on some of those points, but mainly I want to focus on two things. One is the wealth transfer that is taking place, and two, AI in financial advice. So we are currently at a structural inflection point. It isn't a market cycle, it is a structural shift that is determined and defined by demographics, technology, and behavior. It's estimated that there's currently $84 to $100 trillion global wealth transfer taking place from the older generations to the new generations. We are currently sitting with an aging advisor base where the average age of the financial advisor in South Africa is over 50 years old, and we are experiencing globally a young digital investor that is rising. South Africa's wealth is concentrated and it's also aging, and soon those funds will flow from the older generations to the younger generations in South Africa as well. And as you might know, that the majority of our population is under 40. So that is where the wealth will sit over the next few years. So talking about the role of the financial advisor, there's the issues that financial advisors face is the same throughout. One, there's regulations, which brings admin and compliance burdens. Two is generating new business and new leads. Three is succession planning, and I'm sure you have your own challenges as well. The role of the financial advisor is to allocate capital intelligently, to structure risk and wealth for the clients, to protect their wealth. So one is to grow the wealth and to expand the wealth. Then there is the structuring to maintain the wealth and protect the wealth. And then there's the managing of behavior. In these days, with social media and news everywhere, information is everywhere, but judgment is the edge. So the future of financial advice, and I want to stick a bit to this slide, is, in my opinion, investment-led, tech-enabled, and behaviorally intelligent. What I mean by investment-led, and this is the biggest shift, advice must move from product distribution to capital allocation, from selling solutions to designing portfolios, and from commission logic to strategy logic. So investment-led means portfolio construction is the central part of everything. Global exposure is expected. Fees and performance are transparent. Performance attribution is understood. Clients are not intimidated by markets anymore, and they want to be informed. If your advice is not investment credible, it will be compared and priced. Access is cheap, strategy is scarce. On the tech-enabled side, you'll know of all the platforms that's there in the world, the likes of Easy Equities in South Africa, the likes of Robinhood in America, and then social media and all the different places that you get your news and information from. So tech-enabled, I'm referring to the fact that clients need automated monitoring, instant scenario modeling, digital reporting, compliance integration, scalable service delivery, and a lot of other big words. Long story short is, as an advisor, you need to become and need to be tech-enabled. The fact is there that the money is flowing from older generations to younger generations, and that will only accelerate for the years to come. The younger generations are so familiar with technology. They are so quick with technology. They are so quick with adopting new technologies like AI. Finally, I want to touch on behavioral intelligence, and that is where the real value lives. Markets are extremely volatile, and markets are essentially driven by emotions, people that buy and sell. Now, as some of you might have personally experienced, is because I've fell in this trap, especially with Bitcoin, is I buy when I should sell and I sell when I should buy. And the reason because of that is emotions. When you see articles that say it's now a bear market, things are going to crash, and when you see the price is falling 5%, the emotion in you wants to sell. Where if the price goes up and everyone at the price is telling you it's time to buy, and that's usually at the top, and that's when you buy. And this is also where AI can help advisors with the behavioral intelligence. AI removes the emotions part, and it focuses on the intelligence part. So as mentioned, we are living in an aging industry where the relationships are primarily driven, the practices are primarily driven by relationships. And the age is a strength, but it's also a vulnerability. As mentioned, the average age of the advisor in South Africa is over 50 years old, and it's closer to 60, which means that there are succession gaps emerging. Now, these are not just succession gaps that are emerging between passing clients on from advisor to younger advisor. It's also client to client, which we'll touch on now. The thing about clients is they want to be met where they are. They want to feel heard, and they want to be able to relate to you as an advisor. Whether they are older, younger, doesn't matter. Clients want to be met where they are. So there's two very different clients. The traditional client, which is still where the majority of the wealth is sitting, is a lot about in-person trust, which is either built by someone you knew from school or university or someone you play golf with, or it's you live in a small town and you've got a big building and they trust you because it seems legit. Trust is very important, and it's also in person to a very large extent, not digital at the moment. Stability is important, familiarity is important, and traditional clients are very willing to delegate decisions because they trust you, they give you your finances, and you manage it. And there's just that relationship of trust. With younger clients, because you must remember, like Gen Zs and the younger generations to come, they are so used to opinions, constant information from social media like Instagram, from X, from YouTube, from their friends. They are so used to comparison, so used to dreaming of a life of everyone that they are seeing on Instagram, which the algorithms are feeding them the best of the best. So it's a generation that's not easy to win trust with. So younger generations compare fees instantly. They expect digital access. So if they are at 11 p.m. in the night wanting to view their portfolio, wanting to view their performance, they want to view it immediately because they are used to immediate gratification. Traditionally, with existing models, I doubt that it's that easy for most of your clients to be able to do that. That's why you need a unified platform that is easy to access. Younger clients want global exposure, ETFs, global stocks, crypto, soon private funds. They want global exposure. If they hear about something in the news, and even some of the influencers that they follow in the US, they want the same exposure. And then finally, younger generations and younger clients are very comfortable with AI and adopting new technologies. Let me tell you a personal story. So I started investing in the stock market when I was 13 years old. And my first two shares that I bought was Steinhoff and Lonman. So this was in early, just after 2010. I can't remember the exact year. But I started investing in the stock market, bought my first few shares, saw it running up, and I was just amazed by the fact that you can invest companies that you see on billboards and you make your money grow for you while you don't even work. So I saw the fruits of the seeds that I planted, and the share prices went up. I was very happy. I was very inexperienced. I couldn't really understand when share prices was going down, why it was going down. I didn't really understand PE ratios. I didn't understand dividends, but I was just happy to be investing. And by the time I reached 14 or 15, I realized it's time that I get a mentor or someone that really knows what they are doing. And I went to go see a financial advisor. And the financial advisor, when I asked him about some of the things that I knew that he didn't really know about, I started becoming critical. He wanted me to put my funds into a high-risk portfolio in their view. So it was a high-risk model portfolio, but that consisted of balanced funds. So, I mean, a balanced fund, you get some cool balanced funds and an aggressive balanced fund. But for a 14, 15-year-old, that did not excite me. I also wanted to chat about new business ideas. I wanted to chat about Tesla. I wanted to chat about the technologies of the future. And we weren't on the same level. Anyway, my siblings, who's a bit older than me, they said they'll invest with him. And they weren't wealthy clients, but they put the money in that they had. And he bought them, I think it was 4 shares. It was like Sasol, MTN, and 2 more. So they didn't go with a balanced fund. They went with shares. And 2 years later, the portfolio was exactly the same. So the advisor didn't really attend them because they weren't really making revenue for the client. So they also became skeptical. Long story short, they also moved their funds. I moved my funds to Easy Equities, which is a do-it-yourself platform as we currently know it. And I started investing for myself, and they started investing for themselves. And out of that, we learned some lessons by wins and losses. So, for example, a big win in my personal life was investing in NVIDIA in 2014 or 2015. I can't remember exactly the year. But I also invested in companies like Steinhoff, which was a disaster. So you win some, you lose some, but hopefully you win a little more than you lose. The bottom line is now I've experienced the DIY investing. I really back myself now to invest my own money. And the truth is my parents are now growing old. In many years from now, when they pass on, our children, we have 4 children, will inherit their wealth. Now, then we'll be sitting with the decisions. What do we do with the money? It's not money that we really now used to. It's not money we expected. Do we use the financial advisor that they used? Do we use a new financial advisor? What do we do? Or do we just add it to our own Easy Equities portfolios and manage it ourselves? Or do we just fully trust AI to manage it for us? Now, you might say, well, AI isn't there yet. The thing about AI, it's an exponential technology. So who knows where it will be in 2 years' time? If you just think about cell phones, when that just launched, who would have thought that something like Bluetooth, AirDrop, high-quality images, video calling, e-commerce, no one would have expected where it would have gone. And the thing about AI is it's exponential technology. So it might not be able to do it yet very accurately, but who knows what the future holds. Bottom line is, we are sitting with one of these decisions. What do we do? Now, whatever decision we choose, we have a lot of balls to juggle. We have family, we have friends, we've got our social lives, we've got our day-to-day work, we've got the bit of play money that we are investing with, we've got the actual wealth that we are investing. We have to exercise to keep us emotionally managed and all of that. There's a lot of balls we have to juggle. And if I do it myself, well, then research becomes a thing. Tax optimization becomes a thing. Structuring, like should I invest in a trust? Should I invest via business or personal? All of these things become questions. And that's where I believe the solution comes in, where it's a mix of these 3 things, which I'll get to. Bottom line is, then we move to a place where adoption, so this is supposed to be a brain. I realize the design isn't that pretty, but that is where, whether it's my advisor, whether it's AI, whether it's myself, the world changes fast, and I need to be able to adapt. My financial advisor needs to be able to adapt, and AI automatically adapts. And if you adapt with the times, if you manage to to invest in that behavioral intelligence matter that we spoke about, it's a happy ever after. So the behavioral reset, so these are all from research studies and its estimates, so give or take, around about 30% of Gen Zs start investing early, and this is as early as 18, sometimes younger. 20% of those, which I would not be surprised if that figure goes down over the years, but 20% of those use advisors initially as they enter the workforce, and about 40% plus is comfortable with AI, and I'm almost 100% certain that figure will go up over the next few years. As advisors, you're not just competing with other advisors, you're competing with platforms, with digital expectations, with user experience. But it can also be a strength. Advisors need to move from product sales to portfolio strategy. The traditional clients is fine with being insurance-led. They want life insurance. You can just give me life insurance, or they heard an ad, or someone called them, and they know they need insurance for their car, or for their life, or medical aid. And that's how it goes. Currently, it's a lot of commission-based models, product placements, and sometimes there's a lot of incentives on where you place the products. And access was the value historically, because platforms like easy equities, like Robinhood, digital banks like Discovery, didn't really exist. That access has now been democratized. Younger clients want not only to be able to invest, but they want to be able to talk about and to informed advisors about global ETFs, US exposure, crypto, small caps, emerging markets, all the exciting things. They want to do fee and total expense ratio comparisons. They want real-time portfolio visibility on a unified platform, and they want AI-driven research. They'll do it themselves. The information advantage is gone. Information is abundant, whether it's social media, news, other people, it doesn't matter. Information is abundant. It is no longer scarce. The access is commoditized. So historically, being able to get the best news, you had to buy the newspaper. Wanting to buy stocks, you had to go through a massive admin process and through a broker that's not necessarily user-friendly. All of that is now democratized and commoditized. And finally, interpretation is scarce. And that is where the real value lies. With all this information, with all this access, the advisor's ability to interpret and to know what to listen to, what to ignore, when to act, how to act, and to simplistically communicate that to clients is the real scarce and valuable resource. Now, the new value proposition consists of portfolio construction, so not just individual products or various providers, it's an overall portfolio of my wealth. And that includes crypto, it includes stocks, it includes my retirement products, it includes my insurance. Secondly, it's tax structuring. And I'll get to why that is important now and how it fits in with the retail platforms. Thirdly, is the behavioral management, when to buy, when to sell, how to manage that, how to manage volatility, because as you know, the markets are currently very volatile. And then strategic allocation and expertise over access. It's important to give advice from so I'm referring now to the young generations, to advise from their worldview and not yours. We've seen that advice often reflects the advisor. So if you look at things like age, risk tolerance, and comfort zone, the clients want alignment. When the advice reflects you instead of them, that is when trust erodes. When I want to be able to speak about Tesla, Nvidia, Bitcoin, business ideas, if my advisor doesn't really care about it and just dismisses it without a proper constructive conversation, trust will erode. I expect my financial advisor to know more than me. And if I challenge them with something that they don't know yet, I expect them to come back to me 2 weeks later and say, I did some research, here are my thoughts. If you are just placed in a bundle and a world of so many other clients and they just put you in a bucket, trust will erode. Clients want personalization. So a 25-year-old, put yourself in their shoes. They've got a 40-year horizon before they are 65. That is a very long time. It's almost double what they are currently aged at. They've got a high risk appetite, so a balanced fund will not do it for them. And they can take risks because they've got time to make mistakes, but they also want the potential upside for if they get it right. Their income growth potential is expected to go up exponentially over the years as they progress in their careers. So they do not want conservative balance fund, 60% bonds, capital, and the capital preservation mindset. They want to be able to talk and to be able to invest into global tech, small caps, new technologies on a unified platform, because jumping from one platform to another platform, all with different user experiences, with different structures, is not what the younger generations want. And I'm sure it's also not what you like, whether you are 60. You want something that's simple, unified, easy to understand, and transparent. And then finally, to be able to talk about things that is not the usual, like crypto, like emerging markets. Personalization is no longer optional. With AI, it's very easy to capture a lot of data. Essentially, data leads to better AI and better machine learning. So things like risk appetite, life stage, income trajectory, their behavioral profile, digital sophistication, investment philosophy, these are all things that can help you as an advisor personalize better. And with the use of AI, even more so. If your product shelf is narrow, your advice will feel narrow. I want if you've earned my trust, I want you to be able to do everything for me and with me and collaborate with me. Not just investment, not just insurance, not just a specific product in investment, but the whole universe. AI can also assist you with that, but it will also take some learning and some effort. Leads will get harder. With so many cold calls and spam that I still get to this day, and I have so many apps that show me the true caller and all of that, as soon as I hear it's someone I don't know, I immediately press the end call button. So cold outreach is dying. Trust is not inherited. Just because my parents trusted their advisor does not mean I will trust him. It will take time. It will take earning. He will have to earn my trust. He or she will have to earn my trust. Their advisor is currently just a male. That's why I refer to he. And then the fee sensitivity is rising. With all the education there, with all the noise out there saying fees and check your fees, the sensitivity is rising and digital comparison is everywhere. Trust must now be earned, not just inherited. Future clients, and this is where we believe a platform like Easy Equities adds a lot of value in the chain. Users start young, they do it themselves, they buy with some speculation money, they buy a few small caps, a few global companies, and they learn. So it's not just play money, they actually learn how to do it properly. And through that and through consistency, they accumulate wealth, which at the end of the day becomes complex. As soon as you get children, as soon as you become wealthy, as soon as you've got various incomes or whatever it might be, your scenario becomes more complex. And that is where the big opportunity is for advisors. Whether it's tax structuring or optimization, company optimization or structuring, wills, all of that. That is where the opportunity lies, and that leads to advice. So for example, we are working on part of the Easy Advisor launch that we are planning and working towards. We've got in our roadmap, let's call it a matchmaking solution, where certain clients with certain profiles, certain ages, certain risk appetites will be matched to advisors that use Easy Equities that matches that, whether it's location-based, whether it's risk-based, and that is something where we believe comes a lot of value. Retail platforms are the entry points, and it's not just for small clients. Trust me, there's a lot of big clients on these platforms as well. It starts digitally, and it's important to capture clients early because their potential for exponential income is quite high. Getting to AI, is it a threat? or is it leverage? Humans are emotional, biased, and reactive. What I mean by that is, back to the point that I made about my Bitcoin journey, is I've done the research on Bitcoin. I know why it's good, and I know why some say it's bad. I know the mechanics, I know the tokenomics, all of that. And so many times in different cycles, I bought Bitcoin on conviction, and I even had conviction at the top and when it was falling. But just because it was falling, I sold, and I sold at the bottom and I bought at the top. It was just my emotions. And we all have emotions. That's why the stock market is driven by emotions. It's very difficult to control that. So we are reactive, we are biased and emotional. AI is rational, data-driven, and scalable. It can help us know when to stay calm, when to react, when to look at just the factual data and not the emotions. It can help us with creating more curated plans, more carefully planned out plans, and yeah, it just makes everything less emotional. Where I believe is the future is with human judgment, with a combination of machine intelligence and AI. AI changes the economics of advice. It can help you with instant portfolio analysis, scenario modeling and planning, automated documentation, personalized reporting at scale. It can increase your capacity if you just think about how many hours you spend on things like admin and compliance and dealing with smaller clients. AI can help you with all of those things. Margins improve, scalability expands. The advisor of 2030 looks nothing like the advisor of 2020, and the advisor of 2040 will not look like the advisor of 2030. So partner with platforms, and we hopefully that's what we do, but partner with platforms that stay up with the times, that helps you do all of these things, leveraging AI, leveraging platform capabilities, but not removing you as the human element completely out of it, but rather elevating you, because that is the real opportunity. Human plus machine intelligence. So there's 3 advisor models emerging, and you'll probably fall in one or maybe more of these. You get the relationship only, which is just focused on in-person, only human, doesn't really matter about the platform, doesn't matter about the experience, and these tend to be your older clients. You get platform dependent, and this is users that don't even use you as a human advisor. They are happy to do it themselves. They've got ChatGPT, they've got various other AI tools that they can use to help them make their decisions and essentially give them advice. And then you get the hybrid strategy, where it's a combination of these two. You use platforms that's user-friendly, that gives you access to the global universe of investments, but that also has the fact that there is relationships and a human you can speak to in your different situations. Because that human interaction, in my opinion, will not be replaced. We all like sympathy, we like connecting with other people. Especially in South Africa, we are very relationship driven, and that builds trust. But only one of these really compound. The hybrid advisor. You're investment led, you use systems, you are AI enabled, you are behaviorally intelligent, and you meet clients where they are. So here's a few questions, and there's many more questions you can ask yourself, and it's questions you should be asking yourself, and it will help you prepare for the future. 1, is my client base aging faster than I am replacing it? If my top 10 clients passed wealth to their children, would it stay with me? And it's a tough question to ask. Could my practice scale without me? Am I using AI or avoiding it? Would a 30-year-old choose me today? What do I do that a platform or AI cannot? Use these questions, ask yourself more of these types of questions to plan your practices and see how you can equip yourself and place yourself for the future and where the younger generations will move towards. Because once again, that is where the transfer is happening. The bottom line is there is around $100 trillion of global wealth moving, and that will move over the next few years, from the older generations to the younger generations. Around 41% of Gen Zs trust AI. Once again, I believe they will go up. 50%, roughly 50%, has owned or currently own crypto. So if you are just avoiding crypto as a topic and you just don't want to get involved with it, you must ask yourself, will my older clients, when their children inherit their money, will they want to use me? Because they want to ask you about crypto. They want to see, are you positioning yourself in crypto? I'm not saying you should do that. I'm just saying you should take the effort to go educate yourself about crypto so that when your clients ask, you are prepared for that, because it is the adoption of that is also increasing. Just in South Africa, on easy equities alone, there's over 1 million active retail investors, and that is growing by the day. And it brings me back to that slide where I spoke about that is where the trust starts. That is where the interest starts, where they are intrigued by this investing theme, and they will scale their investments. The question is, will they do it on by themselves, or will they do it with you? And your relationship and your reaction to their questions, to the conversations, to what they expect, and meeting them where they are, will determine what they will decide. And once again, the average age of the advisor in South Africa is over 50 years old. So are advisors planning for this change that is coming? The future is not less human. Clients just expect transparency, digital access, personalization, global exposure, and efficiency. The advice world is evolving. The question is, will you? If you are interested in finding out more about what we are building for financial advisors in the investment universe at Easy Equities, here at the bottom right is my email. Feel free to reach out to me, or if you have got any questions or anything like that. I realize there might be some questions in this chat, but yeah, that's me. Thanks for giving me the opportunity.
What a morning. From crypto shift into the mainstream to portfolio positioning in calmer markets to regulatory realities to global operating models and finally the evolution of advice itself. If there's one consistent thread, it's this. Advice is not disappearing. It's adapting.
True. You were a brilliant MC, obviously. Is there anything you're not good at?
I'm not good at sports.
I think you just haven't found the right sport yet. Roller derby.
Define sports.
That's your favorite sport. But thanks very much, Carly, for joining and being co-MC. And thank you very much to the thousands of people who've joined us today. Special thank you, biased as I am, to our headline sponsor, Easy Equities, for joining us today, and for all the team that contributed the content, to the FIA Lazellan team for your contribution, Renette and team from FA News, your massive contribution, everybody who joined us, many of you do so to grow your network, to learn, to share, to get your CPT hours, which is important for many of us. But I think one thing that I take away from today, based on my co-host here, Carly, the speakers, and seeing everybody who's online, is investment and insurance at the end of the day really is about people and relationships. And we don't often give enough acknowledgement to that. And sometimes we make mistakes. But a massive thank you to everybody who contributes to insurance, investment, and I'm hugely excited about the future. We'll see you in March. Make sure you go to InsureTalk.co.za to get your certificates, further information, register and join for the rest of the year, InsureTalk.co.za. And finally, a massive thank you to Llewellyn from CN&CO Events, who's co-founder of InsureTalk, who behind the scenes, sometimes a little bit dramatically, but always brilliantly, make sure that InsureTalk happens really well. So big thanks to Llewellyn also. Have a great rest of the day, everybody. See you next month.